he is largely a Washington operative. What we had expected before the meeting was a 50 basis point cut, but a couple of weeks before that, it was a quite hot August CPI print, so we are seeing 50-50 chance of 25 basis point versus 50 basis point. Now, when we look beyond this quite good market sentiment or an overall picture of this Goldilocks scenario, we think there are certain things to know. The first is, given the start of the easing cycle, the Fed press conference was quite hawkish. So basically, the Powell is saying this is not the start of full-blown rate cut cycle. If we look at the economic projection by the Fed, it's quite resilient. So they kept the economic forecast slightly higher. Unemployment rate was unchanged for 2025, but for 2026 and 2027 was slightly adjusted lower, and there was persistent concern about inflation. So if we look at the SOFR pricing right now, it's more dovish than the Fed dot plot suggestion, which is only 2 25 basis point cut in 2025 and 1 25 basis point cut in 2026. And we are looking for another 50 basis point cut in 2025, but for 2026, we're looking another 2 to 3 25 basis point cut. So what this means is we see an increased chance of the Fed being behind the curve. And if there is significant further deterioration of the labor market, there might be a quite significant worsening of the market sentiment, a repricing higher of U.S. recession, which is not great for the global fixed income market and the spread movement. Now, moving on to our review for U.S. Treasury. Overall, we are still quite constructive on duration. I was in Taiwan and Hong Kong, and our global strategy team was in Europe doing roundtables. One of the biggest pushback we got was our relatively constructive view for the long end duration, and we were willing to go extend beyond the 10-year, even to the 30-year path. I think overall our bullish view on duration has worked out quite well since May, given the rally of the U.S. Treasury curve. But overall, we are still constructive at the ultra long end because we think from a break-even point of view, the real yields is still quite good at the long end. This month, the strategy team did a few quantitative analysis or flow analysis on the U.S. Treasury supply-demand dynamics, especially to address one concern is the U.S. fiscal risk and impact on the supply. So when we look at our 10-year U.S. Treasury fair value, our fair value for the 10-year is still at 3.75%, and at the current level, we still see additional upside for the U.S. Treasury 10-year. And looking at the historical data, we are seeing right now the front end repricing of the Fed cut has a much higher impact on the U.S. Treasury. So let's say if there is a slightly lower inflation expectation or a more than expected deterioration of the labor market, then we might see further upside on the U.S. Treasury movement. Other than that, our U.S. strategy team looked into the next 5 years U.S. Treasury supply, which is around $11 trillion, and there's additional 2.5 trillion of U.S. corporate supply. This is very large, especially in the context there is an increased concern about foreign investors dumping USD fixed income assets. But we're not so concerned because if we look at the Fed, we expect the Fed to continue absorb about 2 to 3 trillion of this supply because of the continued growth of the Fed balance sheet. Also because of the easing of banking regulation, we expect the banks and the broker dealers to hold more U.S. Treasury. That said, we are more concerned about the demand for U.S. corporate papers because a lot of U.S. insurance companies are moving to private credits, a lot of the structured fixed income products. And if there is a retreat of foreign investor demand, then there could be a higher risk of the spread going higher. And just quickly look at the performance of the G10 rates. U.S. Treasury is still delivering the best performance, about 5.8% of total return year to date, which is 300 basis points better than next best one, which is an Italian government bond. And even though the 210 steepened quite a lot, U.S. Treasury, the 10-year is only the only one across G10 that still went down in terms of yield by 40 basis points. So that's a quick one on the U.S. rates and macro front.
Thanks a lot, Zerlina. Just as a reminder, at the bottom right-hand side of your screen, you've got a box in which the Q&A comes. The first question that came in from the day was that we can't really hear you guys. So hopefully you can hear us okay and that the audio is coming across bright and clear. But if there are any other questions, please do drop them in. Moving to the topic of the day, prime ministerial change and political protest. So when we were coming up with the topics for this particular webinar, it was all the rage at the end of last month and beginning of this month with political change in Japan, in Thailand, finance minister in Indonesia, and moving on to the Nepali prime minister. Along the way, we did have outside of Asia, the French prime minister changing as well. So lots of change. But to run through some aspects of what this is, what it means for Japan and JGB yields, I'm going to turn to Zerlina again for some preliminary thoughts.
Yeah, some quick thoughts on this. So the JGB curve actually really went high. The yields went higher and the curve steepened because of the immediate concern about the expansionary fiscal policy. But that movement quickly reversed. I think now the market, especially the fixed income market, is pricing in the winning of Koizumi, and whose fiscal expansion policy is not as aggressive as the other candidate. But if you look at the equity market, it's pricing in the winning of Takashi, who has a more aggressive fiscal policy. But I think no matter what, which candidate would be finally winning, it is almost quite certain that Japan is going to see more fiscal spending, and the impact on the GDP is, the yields go higher and the curve become more steeper. So I think the impact for the Japanese bond market is there will be continued supply coming out from Japanese issuers, both coming from financials and corporates, because if we look at the Japanese domestic market, because of this concern of BOJ will continue hike policy rate. Right now for the October BOJ meeting, that's about 60% probability of a 25 basis point hike. And because of that, the onshore investors' demand for ultra long dated JGB and Japanese corporate paper is not very high. And for the issuers, they also are more inclined to go to the offshore market to issue a USD bond. And because of the narrowing the rates differential between Japan rates and USD rates, the hedging costs for a lot of the Japanese institutional investors, including insurance money and banks, the hedging cost has come down quite a bit. So that makes their demand for the USD paper issued by the Japanese corporates and financials even more attractive. If we look at the year-to-date issuers, the USD bond issued by Japanese issuers is almost $100 billion, and it is up 30% year-on-year compared to the Asia ex Japan. We are only up 3%, even though that is already above our expectation. And if we look at the spreads and yield comparison, we do see quite a good value in the A-rated financial seniors and sub-debt. Mainly goes to the Japanese lifer, which we always have an outperform recommendation on, and some of the selected seniors, even though spreads has been very tight. And if we look at the triple B rated financials, it's still slightly wider than the Asia ex Japan, but not so much, because in Asia ex Japan space, there are some of the NBFIs still offer some spread pickup. And if we look at the corporates, I think we are not so we don't think the double B rated ones are that attractive, mainly because of our not so constructive view on SoftBank coming from Pius, as well as Rakuten, and also coming from SoftBank because of the complex corporate structure. Overall, we think there will be continued issuance coming from the Japanese issuers. There will be further diversification. For instance, right now, Japanese IG corporates account for 35% of the total issuance versus a couple of years ago, it was only high single digits. So this market will continue to receive a lot of attention, and we're also ramping up coverage in this space.
The increase that you're talking about in terms of JGB yields is good news for lots of investors. Some of those are Japanese mega banks, so they do have an investment book, SMFG in particular, going out to say that yields are at a level that they find pretty attractive, so they're going to be adding onto their JGB positions. We also saw that the vote at the BOJ caused some degree of movement up in terms of yields and in terms of higher rate expectations. So that again being good for the Japanese domestic financial institutions. So all in all, from a Japan point of view, we're quite happy with what we see, and it looks like investors are pretty happy with the supply that they see from Japan as well. Moving on briefly to Thailand and Indonesia, Thailand has moved forward. There is a prime ministerial candidate. There are going to be elections in 4 months' time. economic situation continues to be quite murky. Fortunately, a budget has been passed, but we'll have to see whether the new government does stick to those particular budget plans and how the new government does end up forming. We do have underperformed recommendations on the Thai banks, with the exception of Krung Thai Bank, which has an 81, and we have a market perform on that. But otherwise, we find the spreads of the Thais pretty tight in consideration to the challenging economic environment that they have in front of them. We also have underperformed recommendations on the Indonesian seniors. So we have Mandiri and BNI. And there again, the change in the finance minister does portend for more challenges going forward. Fortunately, the protest situation has stopped, but the economic situation again needs to work itself out. Similar to Thailand, a budget has been passed for the following fiscal year. So again, we'll have to see how revenues match up with those particular budget expenditures. Keeping on with the Indonesia track, we can't be too far away from Danantara, which has celebrated, I think, its 6th-month birthday recently. Yeah. So, Laksh, how do you see progress that Danantara has made?
Yeah, we tracked the progress of Danantara and monitored the updates that were released by the Indonesian Sovereign Wealth Fund. This follows on the back of a couple of notes that we put out at regular intervals at 1 month, 3 months since its launch. We welcome that there has been quite a bit of progress. There was updates and progress on the organizational structure. Key appointments have been made in terms of personnel at top executive and management levels. And there has been some financial moves which we welcome. So we categorized the updates in the form of 3 broad categories. One was in terms of debt raising. The company has guided that it is looking to raise what it has called Patriot bonds. These are essentially low-cost bonds that it looks to raise from potentially local businessmen, corporate houses, and these carries very low, below the market cost of borrowing. So this, we believe, is aimed at getting the funds for the Sovereign Wealth Fund, but of course, at very low cost. But from the investor's standpoint or viewpoint, it is more like a moral obligation, or it is doing service to the nation. We do welcome that, but we are also cognizant on how those funds are deployed, and it is for very prudent, modes of investment. Secondly, the company is looking to, or exploring ways to funnel funds into some of the ailing state companies. This is something that we had also flagged in our previous note, and it's a bit more concerning in the sense that the Danantara is looking to infuse funds into struggling companies like Garuda Indonesia and other kind of fledgling companies under the state umbrella. We are just cognizant, or we are just concerned that good money raised at Danantara may be going into some of the investments or some of the companies that may not yield as much results and return as could be generated from investing into more profitable businesses. But yet again, if Garuda or any other company were to recover very sharply, that of course would mean bountiful returns for the Sovereign Wealth Fund. Thirdly, the company is entered into various partnerships with either sovereign wealth funds or with other reputable companies, which is a positive move. It reduces the overall capex for Danantara, be it for infusing into some of the new ventures or otherwise, or even for getting the expertise that is needed to kind of function in the long term in this vertical. Overall, as we mentioned, we generally welcome many of the moves that have happened of late. Having said that, we are still a bit cognizant of and also cautious of the governance and transparency issues. We need more clarity on that. We are quite cautious on that front, and we are continue to watchful of what is happening with Danantara and the direction in which it is heading. So overall, this is our kind of the main takeaways. We still do not change our recommendation on the Indonesian SOEs on the back of these, but we think that in general, it is heading in the right direction.
Great, thank you. It's time to move to the results wrap, particularly in China. The results tend to come out more towards the end of August, early September. We had a number of results out. So I'm going to start with Pius first and the tech world in China. How did they do?
Thanks, Pramod. Yeah, so last month we actually talked about China tech space first half results already. And this time I want to zoom in and talk about the quick commerce / e-commerce space specifically, because that's a hotly debated area. And specifically, the three players that are the focus here. That's Meituan, Alibaba, and the JD. And when I talk about quick commerce in my following discussion, it refers to both the food delivery business, and also non-food delivery business, as both of them are high frequency shopping in a way. First up on our recommendation changes. So firstly on Alibaba, we are maintaining our outperform recommendation, and we are moving our market perform recommendation on Meituan and JD to underperform recommendation. And the reason, apart from valuation, is more on fundamental ground. And specifically, it's on how we think the quick commerce competition is shaping the market. So as we know, the quick commerce competition started in Q2 this year and got intensified in the current quarter, that's Q3. And we think that it's going to extend into Q4 and potentially beyond as well. So what happens here is that the three guys, as mentioned just now, they spend massively in subsidies, which therefore hurt unit economics on a unit order basis. And also they change the market share dynamic in the quick commerce segment. And ultimately it impacts their financials, their credit metrics, and their cash flow. And what we think as this competition goes on and as how it shapes out, we think that Alibaba is gonna emerge stronger, and Meituan is gonna be the weakest, and the JD is gonna be somewhere in between. And this is actually reflected in the June quarter results already. For Meituan, its operating cash flow was down 75% year over year, and the JD was down 50% also. And Alibaba was least impacted, was down 30-something% on operating cash flow on a year-on-year basis. And just quickly on the reasons why the huge difference among these few players, as they all spend massively in quick commerce competition. So Meituan's only business is quick commerce. So there's no other backup. So therefore, it's impacted the most. And you can see that its unit economics dropped from positive 1.5 yuan on a per order basis to negative territory in Q2. And volume market share dropped massively as well, from 80% also to 55%. And on the other end of the spectrum, Alibaba was least impacted because quick commerce is just a small segment of its business. Its e-commerce is doing very well, and its growth driver, i.e. AI cloud, it's accelerating its growth as well. So that's why its EBITDA was only down 4%, and as mentioned just now, OCF was only down 30-something%. So so I also want to spend a few minutes to talk about what we see as the outlook for this competition, as that's what's driving our recommendation. So if I can describe our view on the quick commerce competition in the coming quarter, that would be intensify, strategic, and more blood. So for Q2, it only recorded around 1.5 months competition. For Q3, it'd be full quarter, it'd be full 3 months. And we still don't see how this competition is going to normalize in Q4 and beyond. And it would be helpful to take a look at what Alibaba is thinking. We are of the view that Alibaba views this investment in quick commerce as highly strategic for 2 reasons. Firstly, its entry into quick commerce has already brought cross-segment benefits to its core e-commerce business. So what you see is that the e-commerce business has brought in a lot more active users, has seen more traffic, and has seen a higher level of purchase frequency. And also it saves money from selling and marketing as well. And secondly, I think that's what a lot of investors actually overlook, is that if you look at longer term, quick commerce is very likely to cannibalize e-commerce 1.0. And as we all know, Alibaba is the king of e-commerce 1.0. So Alibaba views this quick commerce competition investment as not an option, it's a must. Right. So when and early on when I talk about more blood, I also want to spend like 1 minute also talk about how Meituan is doing from a long-term perspective. So from a longer term, we think that the quick commerce segment, which was previously dominated by Meituan with around 70 to 80% volume share, is going to move into a more duopoly market and split with Baba. And it's likely going to be 50-40% market share by Meituan and Baba respectively. And from a unit economics perspective, we do see that, as mentioned just now, Q2 unit economics has dropped to negative territory for Meituan. And what's more important, it's from a longer term perspective, because of heightened level of competition, unit economics is going to be down in the longer term as well. And by some estimate, it's going to be down by 40% also in the longer run. Thanks so much for the wrap on.
Thanks for that. It's quite a good run through of the different elements of that particular industry. I'm going to pick up a little bit on the Chinese financial institutions. So the banks also reported, and the results uniformly were in the not good territory because of lower net interest margins. Net interest income is down. Surprisingly, fee income has been a challenge to a greater degree than we'd anticipated, particularly credit card and bank assurance income is lower. The higher yield curve is negative for trading income, but some of the banks took the opportunity to book some gains on some previously brought on board bonds, particularly in semi-high yield category, to book some gains over there. And so operating profits weren't anything to talk about. Despite the current environment, provisions were reduced. And that's to a certain extent because the NPL coverage ratio is very strong. That could be because non-performing loans are low because of the regulatory environment in China, which effectively allows some amount of evergreen officially, given the economic conditions there. So bottom line was that most institutions were 1 to 2% under on a year-on-year basis. And so from a results perspective, not that great. That having been said, we continue with our recommendations, which are market perform on the big five and underperform on the joint stock banks. We use the 3-year floaters that the big five have out there as comps because fixed rate issuance has pretty much gone away. And the JSBs are trading too tight. For the AMCs, which also reported results, I'm just going to look at Cinda, which we moved to an underperform recommendation because the spread differential versus the banks has dropped to broadly the 10 basis points kind of area. We continue with our market perform recommendation on the previous Huarong and now CITIC AMC. There, the underlying story continues to be one where operating profits are negative, but because of the structure which now the AMCs have, where they've been buying up equities in the market. More recently, it started with CITIC AMC in China Everbright, but then they diversified into Bank of China, into CITIC based out of Hong Kong and a couple of other institutions. And Cinda has picked up the same baton and done similarly with a couple of other institutions. So overall, the net profit line is positive, but again, it is because of these accounting related revenues that have come in. Otherwise, from an underlying basis, both of them seem pretty challenged. CITIC AMC in particular. End of last year, they booked some pretty heavy losses. That having been said, we don't think their situation was that bad. We think it was more a question of using the opportunity of the revenues that had come in from other places to really book some pretty heavy credit costs. So that's a little bit of a run through of the banks and the AMCs. I'm just going to move back to Pius now for the Hong Kong property wrap.
Sure, thanks, Pramod. Yeah, for Hong Kong properties, first half performance wrap, I will firstly talk about a few recommendation changes, and then talk about first half results a little bit, and I want to spend some time also talk about the second half outlook as well. So overall, for A-rated property, Hong Kong property names specifically, we think there's still a defensive space versus the index. Despite differing operating performances across some of the names, we are quite comfortable with the leverage level of the names and the free cash flow that's generated from this space as well. A-rated specifically has it is still offering 90 basis points versus the index, and therefore we maintain our overall recommendation across the group with 3 exceptions only. Firstly, we move our outperform recommendation previously on Hong Kong land to market perform. The curve tightened by 30 to 50 basis points since our overperform recommendation, and it's now trading at around fair level at 3 basis points versus its peers of similar rating. We move Sun Hung Kai properties recommendation from previously market perform to outperform, primarily on valuation as well. It offers around 20 to 30 basis points versus its peers against our constructed outlook. And thirdly, on Hysan, we move, actually after the first half earning, we move our outperform recommendation to market perform recommendation. Again, on valuation as well, it's now trading at around the same level as Henderson Land, which we view as a stronger credit. And also we are slightly cautious about the outlook of Hysan, given its still negative free cash flow and high leverage, as it still needs to spend money on its Lee Garden project in the coming 18 months. Very quickly on first half result overall, on top line, the Hong Kong developers as a group did well because higher revenue, higher development property revenue booking. And for Hong Kong landlords as a group, its top lines are slightly pressured because of negative rental reversion on the office subsector side, and lower turnover rent on the retail side. So therefore, it would be helpful to provide our view, our macro view on a subsector level for the next few quarters. So first up on office subsector, we are cautious. We think that occupancy rates are still gonna be soft, and the rental reversion is still gonna be negative. We think that the stabilization in rental reversion is a challenging undertaking. It's only going to happen if we see meaningful pickup in the demand for office space against a very elevated level of supply in terms of existing vacancies and new spaces. That being said, we do see some green shoots though. We see occupancy rates in a few core regions, including Wan Chai, Causeway Bay, and TST are stabilizing. And we all know that IPO activities are going on very strong. So as one of the most important sector of Hong Kong, the financial sector, it's probably going to help with office demand in the coming quarters. And then next on our retail subsectors, we are largely neutral on the retail subsector. We expect occupancy rate and a rental reversion to be stable. We are encouraged by the retail sales momentum in recent months, where it recorded year-on-year growth, largely supported by luxury segment. And for the residential subsector, that's the part that we are most sanguine with. We think that the first half positives are going to continue into the second half. We see that in the first half, primary sales were up 4% year over year, primarily driven by the primary segment and the mask subsegment specifically. So this helps volume, and it actually helps rental yield in Hong Kong as well. So rental yield in Hong Kong now has already reached all-time high. And by our calculation, for the first time in many years, rental carry, meaning rental yield minus mortgage rate, turned positive in May, so which is encouraging. And certainly rate cuts by the Fed and also by the Hong Kong banks would help as well.
Great, thanks for that, guys. We'll move on next to event-based notes, and Vedanta always seems to be mostly in the news. So we'll start off with Vedanta. So Laksh, across to you.
Yeah, with Vedanta, in this month it announced that it is looking to, or it has been emerged as the highest bidder to acquire an Indian distressed company called Jayaprakash Associates. The target company is mainly involved in real estate, cement, infrastructure. This acquisition, which is proposed, is through the India's insolvency court called IBC proceeding, and the amount that is being talked about is in the range of INR 170 billion, which is closer to about $2 billion. The details are still to be finalized by the company itself, and therefore there is not much in the public domain. But they are planning to make, if they are successful finally in acquiring it, they are planning to make the payments by doing 40 billion upfront INR payment, and the rest 130 billion INR over the course of 3 to 4 years. It needs to be mentioned that it is not a done and dusted deal. There is still a few hurdles to cross. One is that the final creditor approval is still awaited. There are a couple other companies that are also in the fray, and prominently the Adani Group is also in the final auction round along with Vedanta. There are other approvals also which will have to come across even if the creditors do approve, which includes the Anti-Competition Commission and also the NCLT. Despite this, based on our financial analysis, it looks like the pro forma impact of this will be quite manageable. At a leverage basis, it would deteriorate by about 0.2, 0.3 times. But what we are more concerned about is that we don't really see a lot of strategic rationale for this acquisition. There is very little overlap with what Vedanta is currently doing, even though it is still very diversified to what Jayaprakash Associates is doing. It could entail a lot of entry into many of the cyclical and working capital intensive sectors, which is namely the cement, infrastructure, etc. And they could probably be facing some of the counterparties who might delay the account receivables. Finally, the Jayaprakash Associates, even if Vedanta acquires these debt at a 30-35% haircut from the current creditors, they would still be staring at a company that is not doing well in terms of their earnings. They are in fact, Jayaprakash Associates is in fact negative EBITDA in the most recent financial year. So we do not see a lot of reason for going into this business, especially just as when Vedanta looks set to emerge from its debt restructuring, and many of its debt maturities seem to be in a position of being able to tackle well. Finally, it also points to the fact that Vedanta has very aggressive capex, and that's something that we have highlighted in our previous company notes on Vedanta as a major risk that needs to be watched out for. And with this kind of inorganic expansion, it all adds to the already existing organic capex of close to $2 billion on a per year basis. So that's something that is overall credit negative for the company. But given that there is still a few more hurdles to be crossed, we have not yet changed our recommendation. We still think that Vedanta's bond, given its very high coupon, offer high yields in comparison to the rest of the South and Southeast Asian corporates. And we do like some of the bonds within the corporates, in particular the 2029, 2031, etc. And we have a positive outlook for the company overall. Yeah. Stop here.
Thank you. I'm just going to add one other thematic point from the financials end, and that's on New Zealand banks. So there's a proposal from the regulator to change how they look at their the capital structure of the New Zealand banks. As a quick recollection of how things have progressed on the New Zealand banking front, this was one of the few regulators worldwide that did not require any kind of bail-in language or any kind of loss absorption on the tier 2. So the tier 2s were effectively old style. That's likely to be changing going forward. Similar to the Australian regulator, the New Zealand regulator is also proposing that additional tier 1 as a category goes away. It's not too large for the New Zealand banks, and it tends to be in the domestic market, so nothing really for the international investors. But for the existing New Zealand bank tier 2s, and there are 2 from ANZ and 1 from ASB Bank, there's a very high likelihood of call on the first date because those would then be grandfathered out. So effectively, they could be considered as in my view, senior debt with a hard maturity. So, offer open till stocks last in case you can get hold of those particular bonds. Those would be good investments to make. And now I'm going to move on to some kind of investor interaction. And Zerlina, you were on a recent trip to Hong Kong and to Taipei. What did you discover?
Yeah, so we met quite a wide range of investors, including the Taiwanese lifers, some of the bank treasury desk, the trading desk, as well as your regional real money and asset managers. We have a few takeaways or observations. The first one is we think the cash level among the investors we met were still quite high. Most of them are talking about high single digits or even low teens. And this level is, of course, a bit lower compared to right post the Liberation Day sell-off. But right now, people are still trying to lock into some of the relatively high yields. And to note, most of the Asian investors are still yield buyers, even though spreads were at historical lows. But from a yield perspective, especially for IG, is still quite attractive. So for these investors, a lot of them are still targeting about 5.5% to 6% in IG, which I think after 1 month, this is becoming a very difficult target now. I think late last month, we still did a note about 5.5% yield trade picks. Now everything is gone below 5%. And for high yield investors, they're looking at 7% to 8%. And arguably, I think if you don't do any single B or triple C, it's also becoming very hard to achieve this. And in terms of the funding cost, a lot of banks talking about interbank funding cost is still relatively high, and also 4%. And for hedge fund and prime brokerage related borrowing cost is about 6%. That also explains why the hurdle rate for IG and high yield is still quite high. So despite the very good year-to-date performance of both Asia IG and high yield, or above 6%, I think it's still not a so easy year for a lot of the investors. Now, the second observation we made is people are still preferring duration over credit risk, understandably because of the tight spreads. And a lot of investors are looking to extend duration. There are certain differences across market. For instance, in Taiwan, we observed investors have higher appetite for duration. Their average holding is about 7 to 8 years, and they're looking to extend duration in IG paper of beyond 10 years. Versus if we move to the Hong Kong market, people are still holding about 3 to 5 years, that type of tenor. And for new issue, they're also looking more short-dated, 5 to 7 years, even talking about extending duration. And one pushback I just mentioned is our relatively constructive view for 30-year U.S. Treasury, because people are thinking about U.S. fiscal fiscal deficit and the supply risk, as well as the long and inflationary risk. So I think for the ultra long end, it's still quite difficult, especially for Asia. The very long end spread curve is flat or inverted. So a lot of investors still prefer adding duration through U.S. rates directly instead of doing in Asia credits, or they choose to do it in U.S. credits or European financials, some of the USD issuance. The third interesting observation is in the Taiwan market, because of the rapid Taiwan dollar appreciation in May, a lot of the institutional investors see huge fund outflow, and that also made them to question whether they should continue continue investing in US dollar, whether they should continue allocating their coupons and redemptions into USD fixed income instruments. But interestingly, that thoughts or concerns quickly reversed starting from the third quarter because of the FX stabilization. And for the lifers, there are some regulation related to increasing their FX volatility reserves, and hedging cost has come down quite a bit. So lifers increased a bit of the hedging cost. So right now it seems like because of the depth and breadth of the USD fixed income market, this is still the go-to destination for the non-US investors, unfortunately or unfortunately. I think the next one is about our spread view. I think compared to the street, we are relatively more conservative. We're a bit bearish on spreads. Since the start of year, it looks like the market momentum just has been very strong, and it's really difficult to fight the technicals. I think over the next couple of months through year end, the spreads are likely to go sideways, even though new supply has been quite big this month, but it's still year to date has been that it's still negative net new supply, especially in Asia IG. There are still a lot of money in the money market funds, and once the Fed start the easing cycle right now, I think a lot of people are looking to rotate out of the short end and into long end, so the demand is there. So spreads view, I think near term is going to go sideways, but there is a lot of uncertainty into 2026, and arguably the buffer for macro volatility, for any global recession, for any political risk has been extremely thin. We did some interesting analysis this month because people are talking about Asia credit fundamental has been so strong, so that explains the tight spreads. But actually, when we look at the actual data, this is not the case. I think the audience probably have heard across our analysts, there's a lot of downgrades, a lot of the earnings trajectory going to deteriorate. If we look at the quantitative data, we did Asia IG and high yield index level credit fundamental tracking quarterly data back to 1997. So we could see in terms of net leverage, the starting point is strong. But if we look at BBB and A, this is already below long-term median net leverage level. If you look at the cash level across IG is still very strong, but for high yield, net cash level is following below the historical median. If we look at the interest coverage, this is really the crack is showing. For the BBB segment, interest coverage is already below long-term median. And for the high yield, this is particularly also the case. I think the only bright spot is EBITDA margin has been quite resilient, of course, IG and high yield, despite tariff concerns, a lot of tariffs. But as we heard from the analysts from a bottom-up point of view, the next 12 to 24 months likely to be difficult for China tech and a lot of other sectors. The other thing we did is a correlation analysis. What we saw is Asia credit spreads has been highly correlated with EM markets, not just EM, but also DM like US and Europe. And it is negatively correlated with US Treasury movement, which means if US Treasury yields going lower, that means the all-in yield is becoming less attractive and all-in yield buyers might retreat. And because of this correlation, I think for 2026, spread might be difficult. And lastly, I want to talk about some of the positioning. So I think the most crowded trade across the spec investors we talk about is the DM financials. So that means your US big banks, your European tier 2s, AT1s, European financials, and in Asia, this is really the Australian and Japanese banks, especially the seniors, some of the GCC bank seniors, and this is reflected in the very big tightening of the spreads across these markets. And the other segment is perhaps the US IG corporates is also relatively crowded. Now the debated area, interestingly, is the Japanese lifers. So people are still a bit concerned about the rising JGB yields, about their FX exposure. And I think this sector is still not very well understood by a lot of the market participants. And we still have an outperform recommendation on it. And I think because of the relatively large supply coming from Japanese financials and corporates, you might see a persistent the yield gap or spread gap between Japanese financials versus the other market segments, but we still like this for carry from this perspective. And The other area we got some pushback is the GCC corporates as well as financials. That's mainly because of the headline risk, but to some extent, that's probably priced into their spread differential with Asia ex Japan. And lastly, still very popular as cross-currency trade ideas. A lot of people are asking about our Australian dollar-based trade ideas. This is probably the most popular one among Asian currencies because of the appreciation potential of the currency, the relatively wider spread compared to Asia ex Japan, and also the relatively steeper curve, both from Australian sovereign curve and the spread curve perspective. Then Sing dollar is also very popular because of the good performance in the secondary market. We got some investors saying they would just close their eyes and buy any new issue because the secondary market performance will be good. CNH is a very interesting one, I think, because the supply has really come out quite a bit across not just Chinese issuers, but also non-Chinese financials and corporates. A lot of people who bought into CNH bonds in the past couple of months, some of them might be taking a hit because of the rates movement. I think for CNH, a big driver is rates. But to be fair, for USD bonds, it looks like it's rates driving the total return as well. But I think for now, we think the China rates are probably going to stabilize from this point. For China rates, whenever there is an equity rally, there tend to be a rotation from the bond funds into equity funds, and that pushes the yields higher. But right now, I think the regulators are a bit concerned about overheating of the equity market, and the PBOC is also a bit concerned about, if the yields go extremely high, then you are going to take losses on the retail holding of CGBs. So I think the rates are probably going to stabilize from here, and we are also quite constructive on RMB, CNH, and CNY because we're past the peak dividend payout season for edge shares, and the exporters conversion ratio is also higher. So I think, it's a slightly long one of our takeaways. I think some of them are in line with our expectation, but some of the pushbacks and debated credits are still quite interesting for us.
Lots to absorb over there. In case you're watching and you're still unsure about whether to invest in Japanese insurers, please reach out to us. We're happy to convince you that it's a good idea. And the CNH market is definitely an interesting space. We saw the first CNH 81 as well from Chongqing Bank. It's a name where the financial disclosure has dropped a lot, so we don't cover it on an ongoing basis. But it much better than what we were thinking. So great over there. Good. So we're going to wind up by just highlighting some initiations we've done. So Laksh and Biocon.
Biocon. Yeah, he initiated on Biocon in this month. That followed on the back of very active investor and client interest to cover that name. So the company is an Indian pharma company. It is as such rated BB flat or equivalent. But since it issued last year around the same time, it has had its fair share of ups and downs. It is at the forefront at one point. So it is at the forefront of the US pharma tariffs. So even though there is no tariffs in place right now, there is, because Indian pharma is exempted from the 50% tariffs on Indian goods, yet it faces the specter of risk that it could face the threat of tariffs from Trump, which could be as high as 200-250%. And the timeline is also uncertain. We do take some comfort that some White House officials have hinted that the pharma sector tariffs may not come for the next 12 to 15 months, so that the pharma companies have time to relocate the production facilities or manage their supply chain. We also take comfort that the company has a very clear deleveraging path, having acquired a biosimilars unit of the US pharma company Viatris in late 2022. So it has shown that it will kind of reduce its leverage going forward from its current 7 times leverage. We also draw some strengths from the fact that its management seems to be quite sound. They have a proven track record, not that many governance risk, and it has a fair bit of solid market position in the biosimilars market, not just in the country where it operates, but mainly in the US and European markets, to which it supplies close to 70% of its total sales. Some of the key risks that we watch out for is one, namely the US tariffs, which is quite evident. Then it also faces, being in the generics types of business, even though it's a biosimilars, it faces very stiff competition and therefore pricing pressure. So overall, we think that Biocon Biologics, it has run up a fair bit in the last few months. Its liquidity was kind of tackled by the company's raising of equity at the parent Biocon level, which it then used to deleverage Biocon Biologics debt. But compared to some of the other peers like Greenco, UPL, and IRB, on a spread basis, we think that there is still some juice left. Not too much, but there is still some juice left. And therefore, we assigned an outperform recommendation, given that there is some comfort, as we just discussed, on the pharma tariff front. And also, we are taking more optimistic about the deleveraging path of the company. So that's where we are at, and we do have assigned an outperform recommendation.
And I think we also went with an outperform on NBN, which we went out with earlier this morning. So any comments there on NBN?
Yeah, so I do a quick one. Compared to Biocon, this is relatively a boring one, a AA rated name, but boring is not particularly bad in this market, given we expect spreads to go wider and we prefer stay in defensive credits like NBM. So this is a government-owned entity, wholly owned by the Australian government, and it runs the fixed line broadband network in Australia, and it's monopolistic position. So on the standalone basis, the margin is not bad, and this is the monopolist operator. So the market position is relatively protected, and the pricing regime is supportive, and it could enable the company to pass through inflation-related costs. The Australian government has shown very strong track record of support in the initial rollout of the broadband system in Australia. It is mainly funded by equity and debt from the government, and now these days the company is tapping the commercial debt market with quite a favorable borrowing cost because of the government backing. And the weakness is like any SOEs, the leverage is very high and the capex is still very high for the future upgrade of broadband system. But because of the government support and funding access, we do not see this as a concern. So this name compared to Asia AA rated credits as well as US AA rated credits, it offers about 15 to 20 basis points of spread pickup, especially at the 5 to 8 year part. We think this is quite attractive. And if you compare this with telecom names in Asia like KT Corp and Singtel, this is a quite substantial spread pickup. We also looked at across currency bonds, so we still see value in their Australian dollar and euro bonds for spread pickup. And for Australian bond, the absolute Aussie yield is also higher than the dollar yield of comparable bonds.
So that's with that, we come to the end of this particular session. There's a lot that we talked through. In case there's anything else that you'd like to check in with us, please do reach out. But for today, we'll call it a wrap. Thank you very much. Enjoy the rest of your afternoon.